Morning, Michelle.
Hi,
Thanks
Andrew.
very much for joining Blue Notes on the morning of the annual result. There's some notable items, some large items in this result. Remediation costs, different changes for how you amortise technology. But if we look beyond those items, how would you describe the sort of major moving parts in this annual result?
Yeah, sure. And so first up, I'd say those items are all in our cash profit. They're all above the line. We know we're accountable for them. But it is useful to look through them just to understand some of the trends in the business. If I do that, cash profit would be up 3%. We've continued to have really strong capital flexibility, actually 11.8% pro forma, so well and truly ahead of where we need to be. We've continued to show discipline on costs, so our costs are down 1.5%, and we've had 5 halves in a row, I think it is, of absolute cost reduction. So we know that our strategy of trying to be simpler is really paying off there. From a revenue perspective, we did a really good job in New Zealand and institutional. The Australian business, things have been difficult. It's been a difficult environment, particularly in the second part of the year. But in that, we're being really focused on where we want to grow. And so while it has a short-term revenue impact, we think that focus is the right thing to do.
And one of the main drivers of this result in the cash earnings side is the credit quality again.
Yeah.
Is perhaps surprisingly good, and this has been said now for 3 or 4 years running that it's better and better. How sustainable is that credit quality story?
Yeah. Well, when I started, I remember my first results, the first discussion I had with you, Andrew, and at that point, credit provisions were a real drag on the result. Actually, we had almost $2 billion of credit provisions, about 3 times this year's number. We had about $160 million of losses for Asia retail. We don't own that anymore. And we also had a mid-market corporate business in Asia, which we've run down, and that was about 80 million of those. So some quite big structural differences from there. Clearly the environment has helped us, and we know that won't go on indefinitely, but we think we're making some good strategic choices in our business that do make us less risky into the future.
And part of that, underlying that, is a sort of focus on the risk-adjusted returns of the business, which has been a clear focus, and also it plays into the return on equity, which has come down in this one. Can you talk us through that sort of return on the assets for investors? Yeah,
and I'll take both of those. If I think about risk-adjusted returns and the work we've done in transforming the institutional business over the last 2 to 3 years, that's been a real central part to how we've thought about it. And risk-adjusted returns is really about making sure that for the capital we put to work, we're being paid properly. And what that's done in institutional is by keeping capital scarce for the team, they've had to really focus on where they can create value for customers, and therefore customers reward us for that. And we've seen risk-adjusted returns in institutional go up about 20% in that time. And we continue to see the ability to do that in that business. Our overall ROE, if I then sort of move to ROE, has also been impacted by the fact we're holding a lot more capital. So when I compare ANZ to the market more generally, we are holding a lot more capital, and that needs to be taken into account.
Yeah, well, if we look at capital flexibility is something that you've called out in the result as quite a strength.
Yeah.
Can investors buy companies for a future income stream. So can you talk us through how you're thinking about that capital flexibility? Is it dividends? Is it something else?
Yeah, I mean, the way we think about capital management more broadly, and we've had this approach now for a couple of halves, or for a couple of years, is that firstly we don't spend the money before we have it. Secondly, we look at what capital we think we need, both from a regulatory perspective and also our assessment of risk. And then finally, we look at, is there a better use in the business? If not, then we look at returning excess capital to shareholders. Our dividend policy, it's less about payout ratios and that sort of thing, and more about what's the most efficient mechanism to return capital to shareholders. This year it was a $1.60 dividend and an on-market buyback, and we announced, I think, $3 billion worth of on-market buybacks during the year.
Well, thanks very much for speaking with us. good luck with the presentation of the result today.
Thanks, Andrew.
Thanks, Michelle.
Cheers.